Have you ever seen your investment account grow, only to receive a tax from that makes you scratch your head? It is a common experience, especially when dealing with investments like mutual funds or exchange-traded funds, often called ETFs. Capital gain distributions on Form 1099 DIV are essentially your share of the profits that an investment company realized from selling securities within a fund, which they then pass on to you, the shareholder. Think of it as your piece of the pie from the fund's successful trading activity, and it is income you need to report. The core mechanism here is pretty straightforward. When you invest in a mutual fund or an ETF, you are pooling your money with other investors. The fund managers then use this collective money to buy and sell stocks, bonds, and other assets. If they sell these assets for more than they paid, they generate a capital gain. Instead of keeping all those gains inside the fund, which could lead to complex tax issues for the fund itself, they are distributed to shareholders like you. This distribution is a way to ensure that the gains are taxed at the individual investor level, preventing a situation called double taxation. To understand this on your tax form, you will typically look at box 2 on your Form 1099 DIV. This box reports your total capital gain distributions from that fund for the year. It is crucial to remember that these distributions are taxable in the year you receive them, even if you choose to reinvest them back into the fund to buy more shares. The tax rate applied to these gains depends on whether they are classified as short-term or long-term by the fund, which usually aligns with how long the fund held the underlying assets before selling. An important distinction to be aware of is that long-term capital gain distributions often qualify for lower tax rates than your ordinary income, which can be a significant benefit. However, not all distributions are equal. Some might be qualified dividends, reported in Box 1B, which also receive favorable tax treatment, while others are non-qualified. Your fund will classify these correctly for you on the 1099 DIV. Understanding these capital gain distributions helps you accurately report your investment income and can even inform your investment decisions. Knowing how these gains are taxed empowers you to manage your portfolio more effectively and avoid any tax season surprises, ultimately leading to better financial health for you.